We're having a live episode of my podcast, which I've changed the name from the E-Hustle to the Better Call Paul podcast because it's more egotistical. And I think the T-shirt's cool. So you will see if you're searching for it in Spotify and Apple and YouTube and so on, it'll be called Better Call Paul podcast from now on. Let me know what you think of the name. So we've put together this impromptu session on the back of the budget announcements for last night, really. And we've pulled it together quickly. I'm actually upstairs because my internet went downstairs, so a little bit of a makeshift studio. But I'm joined with Danny Chiha from Kelly+Partners, who, as well as Kelly+Partners being my accountants, do more e-commerce accounting and other industries, but more e-commerce accounting than anyone else I know. And probably is on the receiving end of more obnoxious questions from business owners, namely myself, from anyone else I know. So when I can get Danny for half an hour or so and just pepper him with questions, I'll take the opportunity. But Danny, how you going, mate?
The most obnoxious question you probably asked is, what do you think about Better Call Paul as a...
That was supposed to stay between us.
But, I love the name. I think it's great.
That's right. Hey, mate, has the last day been pretty busy for you guys?
Yeah, been pretty chaotic, full on. Obviously, we're up late last night just understanding what these changes, the truth is a lot of the changes, and we'll talk about in a sec, but don't come into effect for a period of time. So really just trying to understand things and be as prepared as we can to have proper convos. And as most, when there's uncertainty in the world, people are ringing around looking for answers. Having AI tools available probably took away some calls to us that people would be doing their own research that they never used to be able to do. So that's probably helped a little bit. But yeah, the team have been really good, really responsive, and trying to learn as much as we can, as fast as we can together, which is good.
I'll fix the layout there. I can see that we've shrunk down again. So is the world caving in? I mean, is that the feeling out there, or what's your take just at a top level? Firstly, are you sort of like, well, business as usual? Or are you seeing this as real fundamental change?
It's 100% real fundamental change. But before I go into that, it's I think for the most part, it does have negative sentiment, which is not great, especially in retail e-commerce environment. It is a feeling of shock and uncertainty. And some of these changes are big and fundamental. I think the biggest, probably our take and our frustration is it's been packaged up as this property thing to help with property. And it's specifically, it's actually going to have a massive impact on business owners more than it's going to have, in my view, impact on property, which we can debate and talk through in a second. But for business owners, I think it's quite impactful, and there will be a lot of discussions around structures and is it worth the effort of getting into business in Australia, and what does that look like if they don't make changes to some of these setup stuff.
Yeah, well, look, we're going to get into a couple of questions straight into it, and people can drop their questions in on all things budget for Danny as we go on, try and read them out. But look, we'll get straight into it. Maybe we'll talk about capital gains tax and the shift in capital gains. The big one in the budget really is the proposed 50% CGT, capital gains tax discount, gone from July 2027, I think it is. Now, if I'm a business owner planning to sell in the next 3 years, in plain English, what's just changed for me?
If you plan this, so massive depends. The way that the rules are written or explained at the moment is from 1 July 27, 50% CGT discount's gone, but you do a valuation as at 1 July 27, you get the CGT discount for the value that got created up until that point. And so it's only the value that gets created post that point that the rules are changing for. It's switching to an indexation method, which is quite complicated and has a whole bunch of calculations to work out in terms of the indexation method. But in principle, what happens after 1 July 27 is, say you bought the business for $1 million on 1 July 27 and inflation goes up 3%, then in that next 12 months, your cost base goes from $1 million to $1 million plus 3%. I think it's $1,030,000. And so your cost base of your initial acquisition of a business or a property goes up by inflation each year, versus to try the idea that, assets go up over time, and we don't want you to miss out on that. But where it really hurts is when you start these businesses, you don't have $1 million cost base. You got a $0 cost base. You start the business with just blood, sweat, and tears. So there's, dollars goes in to start your business. $0 going up by inflation is $0. That's essentially on any exit, any value created post 1 July 27 in the current rules is at 47%. On a business transaction, which is just killer. If I just kind of take that a bit further, they brought the rules in to talk about property. Property does kind of go up following inflation, does a bit more than inflation. But if I bought the property at $1 million on 1 July 27, it's going to go up by inflation or a bit more than inflation. So the actual, cost base is rising with the right way, but also it's not really impacting my tax on property too much as long as it moves roughly at an inflationary rate. Whereas you can see with business, when you are building it, it's going to, if you're doing a building your business, it's going to go up much faster than inflation goes up. And you are essentially going to be paying 50, there you go, you got this both. You're going to be paying 50% or 47% tax on value created post that point. It's massive. It's like, it's a big kick in the face to business owners.
Are you seeing, today you would have had probably quite a few reactionary messages and questions and so on. I've seen a few come up, but are you starting to get the question around like, hey, Danny, should we move to Singapore? Should we domicile in Singapore or Dubai? Or are founders starting to say these things?
I was getting that question prior to last night, probably 10 times a week. Like people get frustrated with current government or just regulation in Australia. And so that question was already big. After today, we've got that question like 100 times today. Like, why would you build a business in Australia? You've changed my box size 20 times. Why would you build it? Why would it in Australia if the end result is 50% tax? So yes. And I think it becomes a much more viable conversation to have. Like, people would really consider it. It is worth the move if you're building anything of value. So that's going to flow through more. And I think just to kind of hit that point home, so capital gains tax around the world is concessionally taxed for a reason. Like there's a reason why businesses or every country in the world essentially taxes capital gains different to normal income. It's not the same thing. So for Australia to essentially take a view of we're removing that concession for capital gains makes no sense. And my gut feel is I can't see it the same form for business owners, because I think it is definitely going to drive convo of it's not worth it in Australia or starting business in Australia.
It's tongue-in-cheek maybe question, but it's a good one. I just lost it, but someone said, is it worth it starting then, even starting in Australia?
That's the sentiment. Like that's the question to ask. I'd really, if you're trying to, the effort, the risk, the stress it takes to the business. Like I've had e-commerce founders specifically go, how long till we can get cash out of the business once they start? And it's like, it takes a long time to build your business to a scale that, assuming you don't get lucky, that you can pay yourself well worth what you sacrifice in quitting a job after refinancing your house to put money. It takes a long time. And I think a lot of people potentially will make a different decision.
Now, I've got a couple of questions that come through. Hopefully you can still see because I just lost my...
I can see you only. You look
okay. Yeah, but you can still... It's still going. We're still cooking. All right. I want to just change tact a little bit. Just pivot onto gearing, which is one of my favorite things to pester you at the moment. Just explain what negative gearing is, and then we'll sort of talk a little bit about... My initial reaction on negative gearing was like, we talk a lot about structures of family trusts and then bucket companies and stuff. And I was sort of sitting there, I was thinking about it, and I was like, most big investors aren't impacted by these negative gearing changes because of their corporate structure. So I was like, are we actually just punishing mum and dad investors here who are like, the ATO said the average investor has one property. Like my goal, and maybe it's similar, it probably is similar with you, buy my kids' property. And like, part of what you do when you negative gear is you stretch yourself for your kids. It's like, well, there's a gap between the mortgage repayments, but I'm gonna go without areas because I'm gonna put in money and I'm gonna buy my kids a house. My sort of first feeling like, well, let's just call a spade a spade. You're trying to down investors buying property, but I'm not buying property. Well,
you're not the properties. You're buying.
I'd like to, but
as we all would, but it's just not. It's not realistic.
Yeah. And so is the government then saying, well, hey, listen, you might have 3 kids, but I tell you what, the house that you live in is enough for you. And when you die, you split that house 3 ways and your kids will get 3/5 of fuck all. And I just feel like I'm not debating whether or negative gearing does drive prices up. I'm sure it contributes. I don't think it's the main driver, but I just feel like it's the mum and dads that are being punished without the thought of why they might be buying the properties.
It's actually crazy. Like, spot on. I'll explain negative gearing quickly and then let's jump into that. But essentially the concept of negative gearing is you're losing money on an investment and you're able to offset that loss against other earnings like salary, wages, etc. You get a bit of a tax incentive on the loss of the property that gives you a bit of tax back in your pocket. Every dollar you lose, you're getting somewhere between 25 cents to 47 cents back, depending on your tax rate, back. But largely you're losing money. So exactly what you said is true. It's like mum, dad, losing money. For the most part, mum, dad losing money to try and get ahead in life. As a mechanism, as a political mechanism to actually fix the problem that they presented in the budget as what the problem is of like helping this intergenerational wealth gap. First thing is we're grandfathering all the existing investors and they get to keep negative gearing in their current asset bases. So it's like no one's incentivized to sell any of those assets at all. So, you've just taken a whole bunch of supply out of the market in terms of like, what do we have to buy? Secondly, you've turned around and said, all right, well, negative gearing is applicable on new properties only now. The only property most young people can afford to buy is generally like an apartment off the plan or something like that. If you're talking about new property, as an apartment off the plan. So you now have incentivized a whole bunch of investors that want to get access to negative gearing to go compete on these new assets that are coming off the plan. And then if you say, hey, why don't you just go buy positively geared properties instead? Because negative gearing doesn't work. They're normally like cheap properties in rural areas, which young people also go and buy to try and get themselves in the market. So now you've incentivized a whole bunch of investors to go and buy positively geared properties in rural areas. So, you can now making young people compete on that. It's like, who are you actually helping here?
It's a wild mum and dad investors are driving property prices up. And I think the other thing makes me feel uncomfortable is if in fact this does work and property prices come down, then a whole bunch of people who have invested their hard-earned money into property have their portfolios worth significantly less, which impacts for many of them, for our kids anyway, it just impacts what they're going to leave to their kids. So it just feels broken. Yeah.
They're trying to fix a supply issue, which is we can't get enough houses built and approved by slowing down demand in their head. It's like, why don't we the root cause of like the regulation to build a house in Australia and the get started and the building is screwed. Like, it's so hard to build a house in Australia. That's the problem.
Without going too deep into it, again, I just can't see how mum and dad negative gearing investors are the ones to blame here. But the supply and demand, okay, not enough supply, but the question also has to be why? Yeah. Why? And there's I don't know that it's just young people who are in the demand. I think immigration's huge, is enormous. Yeah. And know that sometimes they'll come and 3, 4, 5, 6 in a house and be able to afford it as well. So I think it's just my personal instinct was like, well, it's just starting to feel a little bit like you don't want people can't be wealthy. Like we just really want to make sure that people can be okay, but not wealthy, but then the wealthy are in trusts anyway. And the
wealthy, it's called, all the current wealthy, it's all grandfathered. I will say just so we understand and cover it off, like the change with the losses, like, so you still get the losses, if that makes sense. Like you are going to lose, say you lose in the first year on that property, that loss carries forward to future years to offset future property incomes or the gain when you eventually sell that property. So the other kind of thing to actually understand is it's not like dead money either. So the whole change and the whole kind of noise around it, you're still going to get the benefit of that loss at some point. It's more just playing with timing than anything else. So you're making it harder for everyone. And really, it's just an issue for the most part. It doesn't make sense to me. And serviceability, obviously, just speaking about young people buying property again, serviceability is going to be impacted by this as well. So the ability to borrow money for someone young trying to get into the market, it changes that completely. I think I saw somewhere like up to 200 grand or something. They were saying your lending will come down. So makes a big difference, man.
Yeah, it definitely feels not super well thought out. And the bottom line is I don't know whether I want it to work or not, because I just don't think it's the right way to...
Even in their own analysis, Paul, they said it might have an impact of like 20,000 houses or so. Like the impact that they were suggesting it's having doesn't even remotely compare to what the immigration numbers are. Like, it doesnent make sense.
That's the unfortunate thing, is it's likely to have no impact on property prices. Yeah, it just came.
And it probably will have a rent. Like, you probably will see a rent increase to compensate for the people that are impacted by it. So
well, that's the other thing. Yeah, that's where we're kind of, and hit questions in. I can only see the Instagram questions at the moment, but you can drop your questions in I'll ask Danny. I'm just going to talk about the timing. So 7:30 p.m. Monday, May 12th was when it sort of happened. So just talk me through it. So if someone exchanged on Monday earlier in the week.
So any property purchased, any property exchanged, owned prior to 7:30 last night keeps negative gearing forever. Properties purchased after 7:30 last night have negative gearing up until 30 June 2027. But then after 30 June 2027, existing residential properties stop getting negative gearing. So there's probably something in that to say too. Like,
yeah, where we were up to, we were talking about the timing of all of this. So if someone buys a property at a certain day, Monday versus today, then what happens?
So everything bought pre-budget last night, so 7:30 last night, retains negative gearing ongoing forever until they sell that property. Properties bought from last night onwards will get negative gearing up until June 30, 2027. And then after June 30, 2027, only existing residential properties stop getting negative gearing. Defining the difference between existing and new is like newly built, you can live in it within 12 months, but once it's sold it's no longer new residential. And if you bought a knockdown rebuild, that doesn't count as new residential either, because it's kind of 1-for-1 on housing. You have to at least do a duplex for it to qualify as new residential to get negative gearing in the future. Commercial properties will still maintain negative gearing. So it's really only existing residential that we're talking about. It's a bit complicated. Like you can see even just me throwing those dates and different types and that, like there's a whole piece to navigate. Yeah. So I'd say if you bought it before last night, you don't need to think about it. If you bought it after, you need to start thinking about it.
Yeah, it's interesting about commercial. I wonder if it will push more people to commercial.
I think you'll find commercial properties will become, like I was saying before about off the plan properties to investors, commercial property will become more attractive, I think.
Diana from Stretch Me Co says, I'm surprised no one is crying on this call, assuming we're still talking about the budget. Oh, me and Danny were crying earlier.
We were crying before.
Yeah.
Yeah, we're very frustrated.
Yeah. It's definitely, I think a lot of people are worried. Do you think, just on a side note, with changes to capital gains for business owners, do you reckon, you probably see it more than I do, the idea of this big exit, the mirage that is the big exit?
Yeah, like I know Nad and Rach and you have been working on clients jointly where they're not running for profit. They're not building the businesses for profit. They're like, and it's changed. Like your whole messaging around this is the story that you guys all talk to, which I think is so true and even more impactful now, which is the idea of just building a business purely to sell one day in Australia is no longer even a thing on the back of that CGT change. So if you're not making profit along the way, and then when you sell it, you get taxed 50%, what are you building it for? I think your message that you've said for a long time, Carla Penn says the same, Nat and Rach in our team say the same stuff. We should be building for profit. We should be building for cash flow. And this is complementing that even further. It's crazy. But I said this before, I genuinely think there'll be some adaptations to this rule because I think it's too harsh on small business.
Well, I think the biggest adaptation to the rule will be probable change of government.
Potentially. I was talking to someone about this today. Unless it becomes a political nightmare, unless we make enough noise as small business owners around the country and it becomes a key part of principle going into the election, they'd leave it alone if they can get the tax money, both governments. So we need enough people to make enough noise to actually make it part of an election promise.
That's a good point. Diana also says, thoughts on the following: companies up to 1 billion in turnover being eligible to get a refund for tax losses capped to the value of tax remittances relating to employment from the 1st of the 7th, 28.
I think that one's just for startups. So I think it's just for startups from what I understand, as in the way they described it as businesses that's less than 2 years old, help people get off the ground and running. But it's only the first couple of years of business. Your losses are only to the value that you've been able to fund that business startup, and you have to make sure you're paying your taxes, which you should be. So yeah, I think it's a good initiative. Of the things, that's a good one. There was also the 20 grand instant asset write-off that they've made permanent, which, it's the bane of accountants' existence. If we have to keep depreciating assets, it used to be everything under $1,000. So we're obviously very happy with that being made permanent. It's been around for a while now and just was getting extended every year. So the fact that's permanent is also good. Those two things kind of line up. There was also the loss carryback rules, which they've made permanent, which is if you paid tax this year and then next year you made a loss, you can get some of the tax back that you had paid the year prior to offset your loss this year. They're all kind of timing mechanisms, but that's another good one. We haven't touched on, which is the biggest shock of the budget and probably the thing that's going to impact most of our clients the most is, I don't know if you're across it, but the changes to trusts. This whole budget was built around property rules and affordability around property in terms of messaging leading into it. Generational wealth convo. But the biggest change, at least from my perspective, for a lot of our clients, a lot of business owners, is this change they've brought into trust. Trying to treat trust like the government lost a court case last year where someone challenged them on some of the way trusts were getting used and the ATO lost it. And a lot of the change they've brought in is essentially going, we lost over here in court, so we're just going to change the rules and do it our own way, which is fucking crazy. But they're trying to treat trusts like company, tax them at 30%, and then, have a minimum 30% tax on your trust, no matter where you distribute it to. And then further to that, if you decide to distribute it to a company, you don't get a credit for the 30% tax that the trust paid, and you end up paying tax again at 30%. So essentially putting a 60% tax in place if you decided to distribute your trust income to a company, which we've never had the whole tax system has been built to avoid double taxation. And this one new rule all of a sudden, and they specifically called it out. So this isn't an accident rule. This is an intentional double taxation setup, which is crazy. We've never had that before in Australian tax. So as far as I'm aware. So
yeah, it's a really hard one because they roll out these absolute bullshit fucking $50 Coles voucher, fucking things that aren't going to move the needle for anyone, and then they absolutely annihilate businesses. But the thing is, people say, oh well, you have to pay the same tax as all of us. Well, that's simply not true. The average business owner is paying a lot more tax than the average punter by the time you add it all together. So it feels like it is becoming a pretty hard place to do business.
It's massively hard. And their trust rules aren't grandfathered rules. So they're not sitting there going, hey, whatever structures you have now, keep it. And we're going to put, from now on, this is how it's going to be treated. They're going, from this date in the future, this is how it's going to get taxed. Go restructure and sort out your stuff.
Diana says, were any asset classes exempt from the CGT changes aside from super?
There was a couple off the top of my head. I can't remember. Farms were exempt. I think deceased estates were exempt. There was a few exemptions through there. I'd be lying if I tried to rattle them all off for you, but there were a couple. Obviously, your primary place is staying tax-free. They've left the small business CGT concessions alone, which is good. Businesses that are turning over less than 2 million and sell, they've got a separate set of concessions for that. But there are some things still in there that you can muck around with, but
getting harder.
Go for it.
So just back to the trust thing, where are we at with that?
You're thinking about your trust right now, going, hang on, wait.
Of course I am.
Yeah, as I am my one. I was my whole life's got to change.
What do we do now?
So, well, the reality is everything that's been announced is not legislated. So concepts. The next step of it is they'll go and write some draft legislation, which will then have to go through a process. The changes for trusts, I think, were to kick in 1 July 2028. So there's a bit of a window to work it out. And until that legislation data comes through, again, this is another one where I expect there's going to be a lot of argument on. And I don't think it'll look the same in final form as what it does today, because it just doesn't make fundamental sense. It's a complete violation of how any of our tax laws have been built. So in terms of what you do now, it's be aware of it, but I don't think you can do too much today unless you were operating out of a trust, which you shouldn't be operating from anyway, which is sometimes you wouldn't do anything.
Yeah. Okay. Just wait. Carry on business as usual for now.
Well,
Diana,
you can't until you see the legislation and some rollover relief to let people restructure without paying CGT. So until they announce that and you see those mechanisms, you can't really do much except, again, be aware, keep learning.
It's an interesting question. Diana's saying is so exempt, and then her follow up was basically, where do I invest now? And there's I think property in through your trust is the best way to make money. I just don't think it's going to slow much down really, but also opportunity. Diana, your business going well. Opportunity for us also to invest properly in our greatest money making asset, which is likely to be our business. So I do expect people just to focus on their businesses a little bit more and try and take more out of their businesses. The tax is there, but let's try and take more out of our businesses. But
you're saying cash flow on an annual basis kind of thing, yeah.
Yeah, but where do you see personally?
I don't. I was saying that before when we were talking about CGT, and I don't know if Diane was on there, but the new changes to how the CGT will work with the commercial properties and that, indexation essentially mirrors inflation. So, and again, I'm probably talking about a topic that everyone needs to go and do a bit of research on and understand, but essentially from 1 July 27, your cost base increases by inflation. So your commercial properties and your resi properties that largely are going to go up in value anyway at the same rate of inflation, the event at the end of it isn't actually too different to the current setup. Even in the government's calcs, they showed some of that stuff. So I actually don't think the property investing changes too much. What will probably change is you won't be doing it in a trust if the rules stay as they are. You'd probably be doing it in your personal name or a company, depending on how that kind of plays through. So yeah, I don't think the assets that move, that don't grow really fast, it's a big deal on. I think the assets where it's a big deal is the ones that have that you build them, they're going much faster than inflation, like your business. When you sell that has a massive impact. The CGT changes. That kind of makes sense, Paul. Like, you understand what I'm saying then?
Yeah, and I think the other way to think about it is, like my grandfather used to say, is when they came from Greece and bought property, is say, well, one way to avoid CGT is don't sell the bastards.
Yeah, 100%.
Yeah.
And primary place is still exempt. So, there's this meant to sound like tax dodging at all. So take this as how you would have to operate. There's a 6-year rule with primary place. So if you bought the property and moved into it as your primary place, and then moved out again and somewhere, that's your primary place for 6 years. So there's a free for 6 years. So first homeowners who are kind of trying to work out how to navigate some of that stuff, it's like, well, like you came all the way from Greece. Some people might have to move to the Central Coast for a little bit and move into a house, but and then move out again. So there are rules within the system to still play with that still will exist. It's just they're making it harder, I guess.
But Danny, can you just talk us through the $20,000 instant asset write-off and actually what that means?
So historically, I think it was just before COVID, they brought this in. Maybe it was a few years before, but historically, every time you bought a laptop, any asset worth more than $1,000, you couldn't claim that whole, say my laptop, $3,000. I couldn't claim that whole $3,000 in my tax return in my business in that 1 year. I'd have to spread that out over 3 or 4 years, like depreciated over time, and I'd get that deduction spread over years. They then brought in this rule that instead of it being $1,000 threshold that you can claim it in the 1 year, they put it up to a $20,000 threshold. So anytime I buy any assets for my business that are less than $20,000, I can claim them in the same year that I buy them. I think this might sound silly, but it's something I have to explain often. You're not getting dollar for dollar back on the asset. So you don't spend $3,000 on a laptop and you get $3,000 back. You spend $3,000 on a laptop and you get a $3,000 deduction, which means it comes off your taxable income. So you get basically 25% of the $3,000 back in your business. So often think they're getting the whole amount. It's on a per asset basis. So if I bought 20 laptops for $3,000 each, so $60,000, I would get that whole $60,000 as a tax deduction in my business tax return. So it's only for businesses.
Okay, while we've got Danny here, so Danny from Kelly+Partners, who was they do more ecom accounting than anyone else I know. You've got a good opportunity to ask a few questions. I can only see the Instagram comments, so I'll keep an eye on. I wouldn't mind one thing before June 30, because of this budget, one thing they must act on or know. What's one thing that every business owner watching this must know is going to happen before June 30?
Yeah, before June 30 answered, none of the changes they put through are before June 30 events. So there's nothing urgent that they need to run and do. But what I would say they need to be reconsidering in their world based on this budget is, the same thing we were touching on before. It's like, start thinking you're building a business for cash flow and profit, not for a big exit one day. Like, you really, the way of treating CGT in this budget means that your big exit is now getting taxed twice as much as it was before. So really think about cash flow when you're building these businesses, not just a payday one day. That would be the biggest change. I don't think it matters if it's before June 30 or not, because nothing that they brought out is that fast.
Yeah, that's good. I think that's a positive to take out of it, is just to reiterate, just to get our focus back on profitability. And that what I think people find is when you've got a business that spins off dividends, well, cry me a river, like you're having lots of money and it's always a good thing. So rather than sort of hanging on with tiny profits, waiting for this big exit, that big exit usually doesn't eventuate, but if it does, the big exit got a little bit smaller and it's just time to focus back on profitability. And
I will re-highlight again, we spoke about it before, like part of the process is get a valuation at 30 June 2027, and that's going to peg your how long you get the 50% CGT discount to that value. So there's probably a play of build up as much value as you can between now and June 30, knowing that going to have a valuation date, if that makes sense. It's probably less, as I said at the start, it's less impactful for existing businesses who have already built a lot of the value in their business versus some, because they'll get most of that value with the 50% discount when they sell, versus someone who's deciding to start their ecom business today, and they spend the next 2 years trying to build it up, and it's worth anything at that 2 year window, but it explodes 5 or 10 years after that. It's really going to hurt them.
No, I'll give you the last question before my kids come home and just destroy the place, unless anyone throws a question in the chat, and I'll try and get to it. But As a result of the budget, are businesses worse off, or are you think nope, it's business as usual, or do you have serious concerns?
I think they're definitely worse off in their tax events. I don't think it's business as usual. I'm truly hoping that some of this gets changed because I think it is big changes. I think the sentiment's worse on the back of it. Like, I think that will flow through a little bit in terms of like discretionary spending and stuff like that. Like, I know personally, the structure of my whole life will have to change on the back of these budgets, as will a lot of our clients. So, I'm always optimistic that we'll navigate them. I'm always optimistic that we'll find solutions and carry as we always do. But I think it's definitely a line in the sand on how we treat business in Australia. And I think it's...
Yeah, agreed. All right, legend. Well, I'll got back to split screen here.
Look at that. 55 minutes in.
Yeah, because I'm watching the Instagram as well, and I've just got your face on the Instagram. Sarah's got a question, which is prob's a dumb question, never from you, Sarah. But do the dividends? Someone asked this. Someone asked this already? Do dividends get charged this same tax?
So when they land in the trust?
Yeah. Well, do you want to talk about how dividends are?
Yeah.
I mean, I think between the lines, Sarah's probably saying, "Well, what do I pay myself? Do I increase my pay? Do I pay dividends? What's the point of dividends? What's the difference?" Kind of thing.
So like we're talking about is only on the changes around trusts. Dividend goes from your trading company. For most people, I shouldn't say most people. For a lot of people, we set up a trust that holds the trading business. Take this as how we understand it today, because it's not legislated or described in any great detail. Dividend lands inside the family trust. They're saying the trust will pay a minimum of 30% tax. So dividend comes in normally in small business at 25%. Tax is already paid. You'll pay the extra 5% tax in the trust, and then it will flow out to the individuals, most likely, who will then pay their marginal tax on top of that if it's above 30%. They won't get any refunds if it's below 30%. So the minimum tax you'll pay on any business income that flows through a trust will end up being 30%. We expect dividends to still through the same way. There is a need for dividends, like we wouldn't get rid of that system. Wages have a whole bunch of other issues, payroll tax, super, workers' comp, etc. that mean that you don't want to be paying wages when you can be paying dividends or should be paying dividends. Where it, again, complicated, we haven't hugely touched in huge amounts, but the trust then distributed into the bucket company. That part, dividend goes from trading company to trust to bucket company. That trust to bucket company part's basically dead. That's where double taxation, that's where the big change kind of exists. So bit of complicated answer for you there, but they still have their place. Don't get rid of your dividends.
And also that double tax you're talking about, did you say 2028?
1 July 2028 is when, so the 2029 financial year. So we've got some time. And again, they give us some restructure rules to manage around it apparently. But, double tax is never a good thing. Just as like most things in the world, they take an inch, they take a mile. So the idea that we let double taxation come in to even just in this one micro kind of example just opens up the idea that we'll let double taxation come in other ways. So you definitely want to if you're a business owner, you want to be making noise about the concept of double taxation because it's, scary, slippery slope.
Yeah, it just feels like there's it's just they're just closing off everything they possibly can, because you sort of, unless you've got, a brother or a sister or an adult son, daughter who just doesn't work, then you can funnel them some money. Like, just know the discretionary aspect.
Like if they want to close off some stuff, close off some of their spending and close off some of their immigration, some of these other issues will go away. Like, there's plenty of things they can close off. It doesn't need to all be tax.
Yeah. Great way to sum up. Now, we should do this regularly, mate. We should do a check-in on Instagram with a regular smash.
Yeah, keen, happy.
Mate, appreciate you as always. And for those that don't know, Danny and Kelly+Partners, you should absolutely be hitting these guys up to be doing your tax. Yeah, absolute ecom experts, but also, not just ecom, do my stuff as well. So reach out to Danny and the team at Kelly+Partners Northern Beaches if you need help. Danny, love you, mate. You're an absolute legend. Thanks for the time today. And I'll probably, Jess says, well done. I'll probably just continue peppering you with questions about farm investments in Bowral probably in about half an hour from now.
I'll let you know when I'm buying my new house in Bali. You can move there with me.
No problem.
We'll move offshore together. Love you, buddy. Grateful. Appreciate you.
Mate. Good to see you. See you, mate.